Our textbook has two problem sets in each chapter, problem set A and problem set B, and the problems parallel each other. In chapter 2, problem 2-2A is assigned, but let's do problem 2-2B to help you get through the first 4 steps of the accounting cycle. And hopefully when you see us go through this, it'll make problem 2-2A a lot easier and a lot better learning experience. So what we're going to do is make a bunch of journal entries here for the first month of this dentist's business. Then we're going to post them to ledger accounts, which are going to represent by T accounts. And then we're going to create a trial balance, and hopefully all our debits will equal all our credits. Our rules for journal entries are: assets increase with debits because they're on the left-hand side of the balance sheet. Liabilities and owner's equity accounts increase with credits because they're on the right-hand side. Expense or debits, expense or debits, expense or debits. Revenue, which is the opposite of expenses, must be credits. And drawings, which are not in this problem, are debits. So first off, on April 1st, Victoria Hall invests $20,000 cash in her new business. So that means cash is going up by $20,000. Cash is an asset, it increased with debits. And her equity is going up in her business. Equity accounts increase with credits. So let's see what that journal entry looks like. We're going to debit cash for $20,000 and credit owner's capital for $20,000. Put a little story here if you want about what happened. For the first couple chapters, your book uses account numbers. They aren't really important, just know that they exist. Okay? Also on April 1st, we hire a receptionist at a salary of $700 per week, payable monthly, but we aren't writing her a check right now, so there's really nothing for us to record right now. April 2nd, we paid office rent of $1,100. Expense to debits, expense to debits, expense to debits. Rent expense is an expense. So we're going to debit rent expense for $1,100. We're paying it with cash. If cash increases with debits, it must decrease with a credit. On April 3rd, we purchased dental supplies on account. What that means is we incurred an account payable from the Smile Company. Supplies are an asset. Assets increase with debits. So we're going to debit the asset account supplies for $4,000, and we're going to credit the liability account accounts payable for $4,000. Accounts payable is the liability account. It increases with credits. Then we provided dental services on April 10th and billed the insurance companies. Don't be too concerned about that. Don't get thrown off by the reference to an insurance company. If someone's going to pay us in the future, that's called an account receivable. So we debit accounts receivable for $5,100. It's an asset. It makes sense it would increase with debits. And we credit service revenue. Remember, revenue accounts increase with credits. It's earned, so it gets to go right into our revenue account. On the other hand, on the 11th, someone pays us in advance. So we're going to debit cash because we collected the cash, but we haven't earned it yet. So what we have to do is incur a liability called unearned service revenue for $1,000. And if we want to make our little note to ourselves, we can say that that's Trudy Bork's deposit for her future implant. On the 20th, we received $2,100 cash for earned revenue. So cash is going up, assets increase with debits, revenue accounts increase with credits. So we debit cash for $2,100 and credit service revenue. On the 30th, we finally pay our new hire for $2,800. Expense or debits, expense or debits, expense or debits. So we debit salary and wages expense for $2,800 and we credit cash for $2,800. It makes sense that cash would be credited because assets increase with debits and decrease with credits. And we paid $2,400 to the Smile Company on the accounts payable. Accounts payable is a liability account, so it increases with credits. Here it's decreasing, so we're going to debit it. So what we do is we debit accounts payable for $2,400 and we credit cash for $2,400. Okay, so that's the first part of this problem. Create the journal entries. Now we have to post them to the individual T accounts to see what our balances are. So for example, the first journal entry, we debit cash for $20,000 and we credit owner's capital for $20,000. So I won't take up your time in doing all that, but that's all we do is post those various journal entries and then strike balances. So we add up all the cash in, subtract all the cash out, and we end up with a $16,800 cash balance. The only other thing that involves any arithmetic is we have $4,000 credit in accounts payable, $2,400 debit, so that means we have a $1,600 balance in accounts payable. To create our trial balance, all we have to do is move the balances in these 9 accounts over to this list, and remember, they're always listed in the same order: assets, liabilities, owner's equity, revenue, and expense, always listed in that order. And when we do that, we have $16,800 worth of cash, $5,100 worth of accounts receivable, $4,000 of supplies, $1,600 of accounts payable, unearned revenue of $1,000, owner's capital of $20,000, service revenue of $7,200, and wages expense of $2,800, and rent expense of $1,100. And when you add up both those columns, you end up with $29,800, and that's exactly the answer we're supposed to have. So this problem 2-2B is almost exactly like problem 2-2A, which is on your homework. And the purpose of this is to get you used to journal entries, posting, striking a balance in those ledger accounts, which we represent with T accounts, and then creating the trial balance. So hopefully this will help you guys do problem 2-2A on the homework. Good luck!